Shortly after I was asked to do this presentation, I came across an article in the Weekend FT, which I thought was very relevant, and basically covered a survey that Aviva had done about people's attitude towards pensions and pension planning. And interestingly, the British public would rather vacuum or change the sheets than review their pension. So that's, I think the fact that we're all here tonight and there's this event being set up and people are given the time, hopefully we're putting a nod in the right direction for that. So, first of all, the broader financial planning considerations. Lifetime allowance. Some of these points have already been mentioned. I'm perhaps going to cover them in a slightly different way. It is something that affects UK pension schemes or people with UK pension schemes, probably particularly in final salary schemes with banks and insurers. For those of you with schemes in excess of £1 million or in danger of exceeding that figure in future years, it might sound a lot of money, but it can easily happen. You need to make sure that you take advice on the options and the remedies available, because the taxation is significant if you get it wrong. Next 2 points I'll sort of take together: unregulated investments and scams. And again, it has been mentioned, but regular features in the press see investors losing money because of high-risk investments or frauds. Despite the efforts of regulators highlighting the risks, people still fall into the trap week in, week out. Consulting a regulated IFA will ensure that any scheme you invest in is legitimate, and they will quickly spot and attempt to scam you out of money. And sort of linked into that as well is the final point there, because alongside that point, dealing with a licensed IFA and confirming they are on the FSA's register, that gives you the peace of mind that you're dealing with a professional firm and that you have remedies available to you should anything go wrong with the advice in the future. Then we're on to tax planning. And again, some of these points have already been highlighted in some of the earlier presentations. Tax relief on contributions, again, it's been mentioned, 50,000 per annum of relevant earnings is the maximum that you can put in and qualify for tax relief. But let's bear in mind, tax relief, it is a bonus, it's effectively a 20% gain on day one, so it's something you should be considering. Tax wrappers, it might be something you hear mentioned. People talk about wrappers, it's an industry term. Tax wrappers, a SIP or a pension, it's in effect a tax wrapper. It ensures all income and gains within the plan are not taxable, and then it doesn't affect your own personal taxation. Tax-free cash. Everybody looks forward to seeing that element of the pension when they come to retire. But it could be 25%, 30%, or now 40% with the new pension freedoms. It is going to depend on whether you're looking at UK schemes or Isle of Man schemes and the new pension freedoms. And it will also affect the age that you can take it from as well. It could be 50, but with other schemes it could be 55. So again, there are various points that an advisor could help you to sort. Timing of withdrawals. It makes sense to time withdrawals in coordination with your personal circumstances to ensure you don't pay unnecessary tax. So if you're able to phase your income in a way that suits your present personal tax, of course, that makes sense. And again, an advisor can help you with that. Finally, inheritance tax. Again, we've already mentioned it's not applicable here in the Isle of Man, although it's a potential issue for anyone considering moving to the UK. So if there is a possibility that you may move or return back to the UK, structuring your investments and making use of pension wrappers now whilst you're in the Isle of Man is very important, because then when you move back to the UK, everything is in a much better financial structure to help you plan and mitigate any IHT that you may be susceptible to. So then moving on to why it's important to seek professional financial advice. We've talked about a lot of the areas that you'd want to consider. So what value can a financial advisor add to a lot of these points that have been raised? Well, the first point goes without saying. The last 3 years in particular, when we look from the UK and pension freedoms, and now we've got this brought in the Isle of Man, the last 3 years have been particularly hectic. But if you look over the last 20 years, there's been constant changes and tinkering by successive governments, and it's constantly moving and evolving. So, taking the next 2 points about knowledge and expert guidance, the people that are working in that environment day to day, they're keeping up to date with the aforementioned changes. They have minimum industry qualifications. There's requirements for ongoing professional CPD, and this ensures that our knowledge is always current and relevant. The next point, a two-way process to promote understanding and educate. And really, I see this as the most important point that I'm going to really raise tonight. Gone are the days when you see an advisor, you're told this is what you want, sign here, and we'll see you again in 5 years if you're lucky. Today's advice is a long-term relationship. It's built on trust, and it's a two-way process to ensure both sides fully understand what is needed and what your goals and aspirations are. And that's what all IFAs are striving for today. The next is confidence and trust in dealing with a regulated advisor. I touched on that earlier. Knowing that you are dealing with a licensed professional will give you peace of mind in your financial dealings. And finally, the ongoing review of personal circumstances. That links with the two-way process really. But regular reviews of your financial circumstances are strongly encouraged in today's fast-moving world. Finally, the investment process. Again, this is a very brief overview. I could probably talk about this slide for an hour really, but I don't have that. Attitude to risk. The word risk often puts people on the back foot straight away. Nobody wants risk. The concept of risk and reward applies in every walk of life, and investing is no different. But the use of software and analysis tools can show you how different level of risk can affect the outcome. Capacity for loss, a relatively new term. It's come into the industry over the last 4 or 5 years. And it goes alongside attitude to risk. This is a measure how you can cope with a capital loss at a moment in time. Clearly someone in the 20s with a lifetime of earnings potential ahead of them has a larger capacity to deal with a loss than someone approaching retirement with a limited period of earning potential remaining. Diversification. Perhaps an area where an advisor can have more influence on than any other. Having all your eggs in one basket is a saying that needs no explanation, but people still do it. There is no such thing as a certain investment. Spread your money wisely. Costs. An area that comes back to our knowledge and experience. It's a very emotive subject, both within and outside the industry. But an advisor has the experience and financial tools to ensure that you're invested in the latest products that have cost very much as a prime consideration. Finally, their drawdown and lack of annuity provider. Now again, I'm overlapping a little bit, and we have talked about annuities tonight. Annuities are available from your pension provider, but on the Isle of Man, if you have a lump sum, you have a sum of money and want to purchase an annuity, there is not an open market option. So drawdown tends to become more of a default option. Drawdown is more complex, but it's also more flexible, a good way of accessing an annual income from your pension plans. But as John said, at the same time, it does bring with it potential risks along the way.